Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Darrell Thomas, and today we have the pleasure of interviewing Harry Dent, who is a best-selling author as well as a financial commentator. But before we get into today's interview, I want to let you know about the New Orleans Investment Conference. Please click the link that is in the description below or that is pinned in the comments so that you can get your tickets to this awesome event where they are going to have amazing speakers, many of the speakers that we bring on this show. And so you can meet these folks in person. You can also meet me in person if you are able to attend. If you are not able to attend in person, there is a virtual option. So be sure to click the link that's pinned in the comments so that you can get access to this exclusive information to help us navigate these murky waters. Hello, Harry. Glad to have you on the show today.
Yeah, nice to be here, Darrell.
Yes. So I want to start with getting your overall outlook of where we are in the markets. I mean, we've had all-time highs for multiple different assets and such. And so are we in a roaring 20s type situation, or where are we at? I mean, based on your historical knowledge and everything, where do you think we're at?
Well, the truth is, Darrell, I've been the most bullish forecaster in history, especially up into 2007 when the baby boomers were driving us. And what I used to always call, this is going to be the greatest boom in history from 1983, 2007. Biggest generation ever, moves into their peak spending at higher incomes ever on a 46-year lag to the birth index, the simplest indicator I've ever found in history. And that happened. Now, the problem is in 2008, where my indicators, literally, I was warning in the 1980s, okay, when the boom started, this thing will be, 2008 is going to be the first bad year and lead us into a long period of slow growth, 2008 to 22, because the echo boomers, there aren't as many of them, to keep the economy rolling. And when that happened in 2008, as you know, we had the biggest recession in decades, and stocks went down 57%. But the central banks and the governments have just been running nonstop deficits and money printing ever since. And basically, we've had, Darrell, the first 100% artificial boom, and more than that, at a time that should have looked more like the 1930s or 1970s at best, but 30s because it would have been deflationary. I always tell people in history, you get long booms, but recessions, a long recession will follow a normal boom like the 1950s and 60s. When you see a bubble boom like into the roaring 20s, it'll be followed by a depression because bubbles just inflate things much more, make things more extreme. So there's a lot more financial asset loss on top of the unemployment. And the financial asset loss, paradoxically, hits the richest people in the country of the world. So what we're at is we had this natural slowdown, but then they pumped up now we've had the greatest stock market boom and a continued economic boom for the last 16 years. And stocks are literally higher than my natural models would have projected, back if we'd have just peaked in 2007 and gone sideways for a long time. So we got the most overvalued markets in history, but worse than that, it's based on what I call the first 100% artificial boom in all of history. And in other words, this boom would not have happened since 2009 without artificial stimulus. And I'm the only guy, Darrell, that's been telling people, here's exactly how much, okay? In the U.S. alone, $29 trillion and still rising at $2 trillion a year at this point in the last 16 years to keep this economy going. So economists get on, or people even just think naturally, well, the economy seems pretty healthy. No, you take back that 29 trillion, we wouldn't have been healthy at all, okay? And it also says to me, if you're going to make a bubble longer, the longest bubbles, and I've measured, Darrell, every bubble in history in the last 20 years since I realized we were in a bubble era like the roaring 20s. The longest bubbles 5.5 years before it just gets so overvalued it blows itself out, even without a recession in many cases. And then you have a depression when all the money and assets and housing and stock prices go down. So we're at a very extreme time now. And so I can't even say what's fully going to happen here because we've never had this stretch to boom, this 100% artificial boom. All I know is it can't be good. And we're not going to have a normal 30 to 50% stock crash and maybe 8 to 10% unemployment recession like we've had in the past. And we get those once a decade. And by the way, Darrell, they're healthy. I am not anti-recession. To me, that's economists' biggest mistake and shows me, since they've never run a business, and I've never met one that has, Darrell, by the way, they don't understand the economy. You can't boom all the time. We can't be awake all the time. We have to sleep about 30% of the time to restore and rebalance. Well, then guess what the ratio of recessions to the total economy is over time? 30%, the same as human sleep. So there's nothing wrong with recessions, but to me, by preventing a recession now for 16 and a half years, the longest by far in history, before the longest time was like 9 years, okay? And typical is more like 6 or 7 without a major recession. We're just gonna have to detox a lot more debt, a lot more what's called zombie companies, and so there's gonna be more unemployment, and stocks have bubbled more, so there's going to be a bigger crash, closer to 29 to 32 than 1973 to 75, or other crashes we've had, like 2000, 2002. That was a tech bubble crash. So I hate to be Mr. Doom after being the most, optimistic economist for decades. I mean, I got criticized, Darrell, more in the 80s for being so optimistic on the U.S. economy when people thought we'd already lost the war to Japan and we're never going to be great again, and we were going to be their slaves or something in another decade, So, I mean, that really was the mood. I got like, Harry, you got rose-colored glasses on, my friend. What's wrong with you? I said, no, I'm looking at the up-and-coming generation, which is the biggest ever in history, and Japan. I was the one saying in Japan in the 80s when they were doing so good are going to be the ones that are going to crash in the 90s. So listen to me. Nope. These people still don't get it. They just see what's happening. So, but now the whole global bubble, everybody, Europe, the North America, South Korea, Japan already, all the developed countries in the world have peaked and at best go sideways for the next decade. And most of them, particularly in places like Southern Europe and East Asia just has peaked forever. The world's not going to be the same for a long time. And we do have to have a detox of this bubble and debt. No bubble lasts forever. And this one's already tested the limits beyond anything. So I have to warn people, this is a really good time to be safe. And safe means, number one, if you really don't know what to do, and especially if you're listening to me and Peter Schiff, and I say treasury bonds are the safe haven because they're the safest asset, and he says no, gold's the only real money, and you don't know what to do, well, you can have both, but I'm telling you, early on, you're going to find out that the gold starts going down and the treasury bond starts going up, and then you can switch to me if I'm right, or if gold starts to accelerate and the bonds don't, you can say, okay, I'll stay with Peter Schiff. But let's put it this way, this is an everything bubble. I also stress that watch gold. Gold is now outperforming stocks in the last 3 to 4 years of this bubble since COVID. Gold couldn't possibly be the anti-bubble if it's one of the biggest parts of the bubble. So everything goes down. So if you're also listening to your normally responsible, balanced financial advisor, and I back these guys for all the history. I just don't back enough because they're like, just diversify and you'll be okay. No, you're not okay if everything in your portfolio goes down, including corporate bonds and stuff like that and junk bonds. And the only thing that goes up is treasury bonds. People are going to lose a lot of money and they're not going to gain it back. And I also project, since the developed world is peaking demographically, many countries and many stock markets will never see new highs in our lifetimes again. They may get good ways back. So this is a time to really be look at your portfolio and say, look, everybody's done well for a long time. I'm saying give up any little more gains they may eke out of this with one more stimulus and just be safe and understand that if we do have a crash, anything like I'm looking at, and all these financial assets going to go down, it is the treasury bonds. 2008 proved this. When everything went down, even gold in 2008, in the end, the treasury bonds, the 10 and 30-year U.S. treasury bonds were the only thing that went up. And there's an ETF called TLT, to play that. So it's an unusual scenario. It means the normal, just diversify and rebalance strategy is not going to work. Be a little better than just being all in Nvidia and tech stocks. But this is dangerous, and not many people are telling people this. Everybody's like, it's okay. The central banks won't let this happen. The central banks, Darrell, are the problem, and the government's $2 trillion deficits a year since 2001. No balanced budgets and accelerating since the 2008 crisis. They're the problem. They're the reason why we have a bubble. Bubbles are always when debt grows much faster in the economy, and then that drives financial assets much faster in the economy, and then the whole thing's got to come down to normal at some time. And that's what I think we're going to see between 2026 and 28. So hate to be the bad news bear, but to me, it's just reality. Anybody that looks at all the financial charts and says this is not a bubble, don't even listen to that person, because these charts, I can't even compare them to past bubbles. They're so much bigger and longer.
Yeah, for sure. Yeah, appreciate that outlook. So you went from Mr. Boom to Mr. Doom. So I want to pull on a few threads in there. So one, you mentioned this period of detox, and so I'm kind of thinking about, I used to work with people that would come out of rehab and all of that. And typically you go into detox for a few days, and then you go into rehab for months or sometimes years, and you get out and go to AA and all of that. So it's a whole cycle with that. So just using that same analogy, when we detox from the stimulus punch bowl, how long do you think we're going to be crawling out of that hole? I mean, obviously, if we've been inflating this artificial bubble for the last, 17 years, I guess, since 2008 or 2009. How long do you think it's going to take for us to climb out of that?
Well, history's pretty clear. I mean, we have this it's called a 90-year cycle. That's also something well known that nobody talks about because it's so extreme and it's so difficult. The last 90-year cycle hit from 29 to 32 crash. The economy didn't bottom until into 1933. The whole decade of the 30s after that was more sideways and mediocre, with one more crash from 37 to 38 before really all the deflation got out. So that'd be the same scenario here. The first crash here, if it's peaking here, and I think this is the most likely time, really right about now, recently or just ahead of us, the stock crash should go into early to mid 2028. The economy shouldn't come out of it until mid to late 2028. And then the millennial demographic boom is at its best into late 2037. So then we would have another maybe approximate 9 to 10 year boom there. It wouldn't be as bubbly. After bubbles, people get it. Okay, they get whacked so hard. No more bubbles, but we could have a healthy 10-year stock and real estate boom and stuff after that, just not bubbly. So that would be the national down 2 to 3 years. After that, the economy's not nearly as strong, and certainly, like I said, no more bubbles and stuff. But we could have a reasonably healthy economy from mid 2028 into late 2037, and then America kind of peaks like Japan did in 1989 to 96. We peak long term, and again, we'll kind of quite never be the same. Okay, we're not going to be the growth leader of the world. India is going to take over China big time. China has already blown its wad so far that even with its some urbanization left, they're never going to. They're 22% vacant real estate from overbuilding, overstimulating. They're the biggest bubble in the world. They may never fully recover from that. So China's pretty much dead. India and Pakistan following them will be the growth generation in the third world, up and coming, urbanizing. And the United States will be the best house in the slowing developed world, because we still have higher immigration, better demographics than everybody except for our cousins in Australia and New Zealand. They'll be the best Western country, but not many people are going to move there or invest there. It's a small market, but I mean, that's what demographics say, and demographics are just the most factual thing I can measure and project an economy and Darrell out decades, 40 to 50 years. I can go out pretty safely and say this is kind of what it's going to look like, other than political ups and downs and stimulus ups and downs. But all of that's more artificial.
And why should you look at Vizsla Copper? Well, firstly, we have a huge resource base already. There's nearly 4 billion pounds, 2 million ounces in the ground at good grade in an excellent jurisdiction, in a place where you can now develop projects. And we're seeing Canada, BC particularly, showing a real commitment to providing development companies with mining permits. You can find more about Vizsla Copper at vizslacopper.com.
Yeah, and you know, like, I mean, sometimes people are overcritical and they say, oh well, the broken clocks right twice a day, or whatever the case. But like when you're looking back in history, you know, a 5-year window isn't I mean, it's pretty small, like when you're looking at massive years. So even, you know, later on when folks are even watching this interview or whatnot, you know, or reading some of your work of the bubbles that you predicted, you know, it's like, okay, well, that was within like a 5-year window or whatever. So like, you know,
it's more than that, Darrell. I mean, there's a concrete, I mean, this is a measurable, they have been stimulated. This 29 trillion occurred in the last most of it in the last 6 years. Okay. Mm-hmm. So that's what's kept it going. And they are pulling back. They did drop the balance sheet substantially now they're not dropping anymore, but they did drop that substantially for the first time. And now it's just a deficit. So you got about half the stimulus going. And that's enough to me, because the other thing, if you understand any artificial stimulus, whether it's heroin or alcohol or any other drug that keeps you going, you know, short term, you know, it takes more and more to keep the high going. And so even just pulling back the stimulus in half is enough to burst the bubble, in my estimation. And I think we'll know if this bubble is going to burst near term. It should be peaking now, and we should start to feel it by early to 2026, early to mid 2000. If we don't see it by then maybe people are better to just stay in with a tight trigger if things start to weaken. But right now, I say it's just better to be out, because the bubbles crash faster than normal markets, and the first wave down out of 3 you're going to get of a major bubble is typically 40 to 50%, Darrell, in 2 to 3 months. You get the worst whack right up front. So the people that say, well, I'll wait and see if people like Harry are right and then reevaluate, you'll get whacked so hard, you'll panic at the bottom of that first crash, then it'll bounce against you and you'll feel like a fool. And then most people will say, oh, I guess I was wrong, and get back in. And then you'll get the next wave down and get whacked just as hard again. So this is very tricky. And again, I say be in cash or treasury bond, or short stocks is the best way to profit if you're an aggressive investor, because most of that will hit in the fastest in the first 2 to 3 minutes. After that first crash in stocks, it's going to be so volatile. I'll say then you get into the treasury bonds. They're more stable as they go down and play the deflation, and they will give you your best returns later at the worst of the crisis. So I say start short stocks for most people, just single short. SQQQ is the best ETF, but it's 3x. So I say, look, just buy a third of it with your pile of portfolio or cash if you just want to be 1x short. And that's enough, because stocks go down twice as fast as they go up. So be short for stocks. Once that first crash hits, then you can sleep at night and just sit in the safest asset on earth, 10 and 30-year treasury bonds, TLT ETF, easiest way to play that, 20-year average, and just let the crisis build. And then when you see the worst of the crisis about 2 to 3 years from now, then you can buy back stocks, and especially real estate at values you will never, ever see the rest of your life. And you can do it with money that you didn't lose, so you have nothing left to take advantage of the bargain. So you can't take advantage of the sale of a lifetime coming around 2028 if you don't preserve your assets now. And if you put them in the treasury bonds, you ought to be able to grow them 40, 50, 60, 70% during the crisis.
Yeah. I have a question in regards to like how, so when we think about the economy currently, it's almost like two separate economies between Main Street, Wall Street. Some people have assets that are increasing significantly. Some people are struggling to buy a home. put groceries in the fridge, and unemployment's been creeping up as well. And then the concern of like AI taking jobs and such. And so just thinking about like the Main Street economy, who seems to be already kind of on the struggle bus, especially with this inflated bubble as well as inflation. Many of them don't own assets and such. And so I'm kind of wondering, like, how much worse is it going to get from them versus like those who have like many assets, who may have like a 50%, 80% drawdown in their wealth.
Yeah, I mean, there's no question in my mind, Darrell. There's no question. I mean, they were just saying almost all the gains in the last year, the economy and the financial assets, they've gone to the top 10%. So that's a bubble boom favors the affluent that are in the growing business, have the assets to invest and benefit from the bubbles. Most everyday people don't have that much money in the stock market, and if they do, it's in their pension plan or a small 401k plan or something. And so when this flips, the good news for the everyday person, yeah, everybody's going to get hurt. Everyday people are probably more likely to lose their job temporarily for 3, 6, 9, 12 months or 2 years or something. But it is the top 1% at extreme, and 10 and 20% that own the top 20% own 90% of the financial assets almost. They're the ones that are going to get hit the most. They're going to lose their entire net worth, and a lot of them being leveraged could have a negative net worth. That the high-end homes will go down more than the everyday house. And that happens in any downturn. High-end homes always go up faster, more, and go down more. So it is the rich people that have been so favored by this bubble are going to get hit much harder. Now, they could lose 90% of their assets and still have a lot more than the average person, and they could lose their job and stuff, or a lot of their income, but they're not going to be struggling at, I don't know if I can survive level, most of them. And this is going to put more everyday households in that, oh my gosh, how do we survive this? But they are the loss, the everyday people are not going to lose that much more, and their house is not going to go down nearly as much percent, and certainly way less in dollars than for the upper class. So I think this is when the people benefiting from this bubble get the whack the most, because they are the bubble. The top 10 to 20%, and what they invested in, where their money is, and their racy businesses and stuff, and all these technology companies at high value, they're the ones that are going to get hit so hard.
Gotcha. So I'm curious about because some folks may have the view that, okay, well, the Fed's just going to turn on the money printers. We're going to inflate, and we're going to inflate the bubble again. And so I'm curious on your perspective there. Is there a point where the money printing just doesn't work, and this just has to be washed out, or could the Fed save the markets again, like they have been the last few last years? I mean, since 2008, pretty much.
Yeah, Darrell, that's definitely the $1 trillion question. No question about it. They will react. They will try to print more. The problem is, unlike past crises, in the 1930s, they didn't print into the bubble, nor they didn't even print after the bubble burst. Okay, they have been printing money, stimulus. They've already blown most of their ammunition. 29. I got the number. Nobody will tell you that number. 29 trillion in ammunition they've blown. So what are they going to do now? Say, oh, now that you got a deeper crisis than last time, and their plan's going to have to be, they're going to have to top that. It takes more and more to keep a bubble going and to fight the next crash. And that's just the logic of bubbles. So it's going to, yes, they're going to try to, but remember, the first crash is the hardest and fastest. So they're going to get whacked so fast that half of the crash is over before they even have time to push the button. And when they push the button, there's some initial thing, but it takes a year and a half for that stimulus to filter into the economy. And that's a rule. I mean, everybody knows that. Year and a half. So they won't be able to react fast enough to the steep bubble that they created that will burst way faster and steeper than it bubbled up in the first place. That's the trap. And they've lost credibility because people now have seen, well, wait a minute, we had a bubble burst, back in 2000, you saved it, and then we had the economy go down in 2008, 9, the Great Recession. You blew us out of that, but we always ended up what? we always got a bigger bubble, and we always got a bigger downturn. And that's what we've had. Bigger booms, bigger busts. So at some point people say, wait a minute, now you tell us that it's going to take 30, 40 trillion in money printing and aid and bank bailouts and stuff. Whoa, why don't you just let the damn thing go down? Let's get it over. I mean, I don't know what actually, I'm just saying people aren't stupid. And at this point, it's going to be very hard to react fast enough, big enough, because the downside momentum is going to be so fast and hard. So I don't think they're going to be able to beat this. I think this one's going to beat them. And I want it to beat them. I may sound like an idiot. I want this bubble burst to happen. If we let it burst when it should have, if we'd have let the 2008 downturn just go another year and a half, instead of washing out 10 to 20% of the debt, we'd have been like the 30s and washed out 60, 70, 80% of the bad debts. And we wouldn't need a detox in the future, you know what I mean? And now we've got more debts than ever. So if we'd have just let the economy, if we'd have just, here's my thing. We, the United States, okay, and Adam Smith, and we the Westerners invented free market capitalism in the late 1700s. Greatest thing in history. And it just happened to come the same time we invented democracy to help balance and counter it for the everyday people. It's the beautiful marriage of all time. We've been booming like crazy ever since. And now, just to avoid a normal 10-year recession, we're willing to compromise the whole system and just say, no more free market capitalism. Government's taking over. We're going to make the damn economy grow whether it wants to or not, okay? No recessions. No recessions means you get more unhealthy and you don't eliminate debts, and free market capitalism fails. Free market capitalism has to have booms and busts. It has to have the freedom to expand and the freedom for these debts and investments to fail. George Gilder's the only economist I listen to, because he says failure is more important to free market capitalism than just the opportunity for success. You have to have both. That's a smart economist. Most economists think, no, our job is to make the economy grow every day at 3% and never have a recession again. And oh my God, don't have inflation. Inflation finances the greatest economic revolutions in history in advance, just like young people are going to be the next booming generation. You look at inflation in history, inflation 70s, 80s, 90s, boom. Happens all throughout history. Economists don't understand our economy. And I'll tell you, there's only one reason for that, Darrell. They've never run a damn business. Not one of them ever run a damn business. So how would they, people who run a business know that when a recession comes, they have to make changes. The next thing they go, oh my God, we could have cut all those costs a long time ago. We were asleep. Oh my gosh, we could have gotten in these new markets and gotten out of these bad markets a long time ago. We were asleep. Recessions are a wake-up call. They're good for the economy. Crises are good for businesses. It forces them to step it up and innovate another level. People in business understand this. Economists don't. They don't have a business. They don't work for a living. They just preside over the economy and cause these bubbles now.
Yeah. So you mentioned inflation. So just thinking about after COVID, the M2 money supply skyrocketed with the amount of money printing. Then we experienced inflation for the first time in decades. Well, yeah. It's been at a consistent rate, but then it got up to 8-9% CPI inflation. But other statistics show higher. But just thinking about that, obviously, if the government is wanting to try to evade this crisis or keep it from happening too long and artificially inflating other bubbles and printing money and such, what does that mean for inflation? Does that mean inflation could come roaring back as far as like the CPI and such? Just curious on that.
It did come roaring back temporarily to that 9.3% you were talking about. That was very temporary. I have an inflation indicator. It's not caused primarily by government deficits or money printing. It can be at extreme. The biggest cause of inflation is when there's a lot of new young people coming into the economy because they cost everything being raised. And even when they first enter the workforce, they still cost more than they produce until they become productive workers and expand both supply and demand. And that's what causes a great boom, like the 50s and 60s or the 80s and 90s. Okay. So the young people. And so we're not going to ever see a great inflation again unless it's caused by massive money printing. And again, even with as much, and again, there's never been a money printing and deficit scheme like this, even close in history. And we only got 9.3% for a short period of time. And that came down very quickly just by fighting it a little bit. Okay. So that's not the problem. We'll never have to worry about inflation again. The problem is it's called money velocity. And if money velocity is going down, we're not, our productivity is slowing. We're not pruning these unproductive businesses and debts. And so the overall money velocity has been dropping since the first bubble in 1995 to 99. It started dropping in 97. It's still dropping up until recently, and it's going to drop again. So money velocity is the only true indicator that tells you, okay, economy looks healthy, but you need to see an economy that's healthy with money velocity that's flat to going up, not falling rapidly. That's cheating when money velocity falls. That means you're growing through stimulus and debt and unproductive debt, not from productive investment. And money velocity is the only thing that measures that. And ask yourself, how many economists, other than Lacey Hunt in Austin, Texas, talks about money velocity to the public? Nobody. The most important indicator, from my point of view, along with things like the demographics to tell you when things should grow naturally or not, and technology cycles, those are good too. But that's the everybody should always know where money velocity's at, and it's been the worst in history. And guess what? The last time it was this bad? Early 1900s into 1932, roaring 20s bubble, and the bottom of the Great Depression was the last long, great fall in money velocity. So we're towards the end of that fall. That alone would say, folks, I'm sorry, I don't care what the economy looks like. This is going to end up in a depression. That's what money velocity has been saying for years.
Yeah. Thanks for sharing that. So just pivoting a little bit, obviously at VRIC, we're into natural resources. Much of our audience is into gold, precious metals, and such. And I'm happy to hear diverse perspectives and from folks that are not within that echo chamber. And so, just thinking about gold, silver, precious metals. You mentioned earlier that gold is rising within this bubble, and so.
Yeah, it's actually beat the S&P 500 by a good bit since COVID, the last 3 years.
Yeah,
nobody
exactly.
thinks that way, but gold has had a really good run.
Yeah, it has. And so thinking about the stocks versus the physical metal, does it matter? I mean, obviously the physical metal would fall as well. People typically sell gold, especially to get liquid or whatever the case may be. But
demand, it has its silver has more, but it has its industrial uses as well. So that will affect demand for gold and silver, but it'll affect silver more.
Mm-hmm. Yeah. So do you have a particular view on the physical metals versus like the stocks, or are you saying that all of it's going to get impacted the same or go down the same amount of percentage? Just want to get your perspective there.
I do have a view on it all because I have to study it all. And the truth is, gold has only bubbled more recently. Overall, gold has not bubbled as much as stocks have all the way back to 2009. Gold will fall. To go back and erase the bubble, gold just has to fall maybe 60%, 70% at most. Stocks, and this is scary, stocks have to go down 90 to 95%. Okay, the S&P 500 more like 90 and the NASDAQ more like 95% to race their bubble. So gold will hold up longer as the bubbles burst and go down less. It will eventually go down, and that's what it did in 2008. It held up at first, but then eventually went down. But gold went down at worst 30 to 40% for a brief period of time, while stocks went down 57%. So in this case, gold will not go down as long or as steeply, which means that if you do want to hold it, it's easier to hold. Nobody's going to hold stocks when they're down horribly for 2.5, 3 years and beat you to death. But it is. I would recommend, if I'm holding gold, I would be getting it out of it here. I think that we're very near the top, and boy, if it goes to 5,000, I would absolutely sell every ounce I have. But when things go down, I would buy gold ahead of most stocks, because the biggest, not only will gold be a great value again, but the biggest driver of the next global boom is not going to be China. United States will do better than most developed. It's going to be India. India is going to be the next China. And I'm talking for the next 4 decades. And you know who the biggest consumers of gold as a percentage of GDP? 3 times as much as China? India. So I think gold's greatest heyday in history, not because of worrying about a financial crisis, okay? Not as a crisis hedge. Gold is a fundamental thing in the industry of the world will have its greatest boom from around 2027, 28 into the 2050s, maybe 2060s. I mean, gold will be, if you're going to have a commodity portion of your portfolio and you want to put it in one thing, and that's what I'm going to be recommending, let gold be the commodity part of your portfolio because it will be the strongest and most basic in history. So I think, again, gold, if somebody says you got to own the NASDAQ or gold, easy decision. I'd rather hold gold during the downturn, okay? But I don't want to hold either. But I would be the first. I think stocks are going to be very slow to come back, and gold is going to be stronger, and gold's going to be gold's be something you can just buy and put in the basement again, because India is going to be its best friend. And India, nobody see it. I go to India and people don't see it. They just see they're poor and they'll always be poor. Well, India, when China took off back in the early 80s, India today is in a better percent in urbanization and GDP per capita than when China took off. So if the next 4 decades favors India's urbanization, which is huge, they're going to go from 35% to 80% plus urbanization in the next 4 decades. That's 3x. People don't know that. Just moving a poor person from the countryside to a major city is 3x in GDP per capita before they get better education or do anything else, okay? So that's going to be the biggest driver of the next economy, urbanization of India, just like China in the last 4 decades. And gold is going to be one of the biggest benefactors of that. So I'm going to be buying gold at the bottom of this crisis, but I'm not going to be holding it now.
Yeah. Gotcha. Thank you for
Although
that.
rather hold that than most things.
Yeah. Gotcha. Okay. So just thinking about the miners and there's a lot of government policy being passed around securing of resources, and there's a lot of protectionism policy going on around the world. And so some folks are saying we're in a mining boom. We're going to be in a mining boom because we haven't, this sector has been starved for capital for a while, since after the 2011 blow off top and such. And so I want to get your perspective there, because it seems like the security of natural resources, rare earths, copper, all of these different things that are being put in like strategic reserves and everything. Just want to get your perspective there. Do you see some room for some room upward for mining?
That one's harder because it's more complex. I don't see upwards. I mean, everything will go down in this sort of thing except these treasury bonds and stuff. But it probably will hold up better. There may be some support for the government, but it's hard to support some say, oh, this is a strategic asset that we have that when it's falling like a rock. I mean, nothing looks good when it's falling like a rocket, because a lot of people have been told by Peter Schiff in particular, who's smart enough to predict this crash. I mean, when I have to speak with Peter Schiff, we have the same damn presentation for the first half. If I follow him, I have to take out half my slides. But if gold if gold does fall with everything else, just not quite as much, then people are going to be more confused and stuff. But I'm not going to be confused because I'm going to see gold as probably the best relative value because its potential, its fundamental potential is heightened in the next boom. And for stocks, it's only heightened in the parts of the world that still have strong demographics, which is only going to be in Southeast Asia and India and in the Middle East and places like that. I mean, most of the rest of the world is going to have at least peaked, if not be going straight down, like East Asia and Southern Europe. So yeah, I wouldn't hold it if it were me. But if somebody says I have to be invested, I have a certain portfolio, yeah, I'd rather the money be in gold than it be in stocks, no question.
Mm-hmm. Gotcha.
It'll be less volatile, and it will not go down as much as the stock market will.
Okay, gotcha. And so I do want to touch a little bit on oil. So oil's already been selling off for the last couple of years. Some folks are saying that recession is coming. Some are saying that we were already in recession. And so obviously, if recession and more further downturn is happening in the future, then that could be a negative impact for the price of oil.
Yeah.
If we've already been in recession, some would argue that, okay, well, oil is, probably closer to its bottom, and, then we boom from here. And so just want to get your perspective on the commodity oil.
Yeah. No, I mean, there's no way oil's near bottom. Okay, oil's going to go down. It goes down as much or more than any commodity. It's so central to the world. It's a leverage factor for the world, and it will go down, but it will also bounce back strongly. Because the emerging world's still growing, and they're going to be adapting more and more things that are energy intensive as their standard of living goes up. And again, especially India, which will be the leader of that. So oil's another thing I'd be very happy to buy when it crashes, maybe when it's like $5 to $10 range. I'd rather hold gold here than oil in a downturn.
Yep. Gotcha. Okay, cool. Yeah, I appreciate that insight and everything. So anything else that the audience should know about what we're facing, what we're going through? I mean, you explained a lot. And so I just want to give you the floor if there's anything else you think that the audience should know or to be prepared for.
Well, the thing is that the real truth, this is what I call a great reset. It only happens once or twice in a lifetime, okay? Really once at this level, like the early 30s and stuff. It resets everything. What it is a huge opportunity. The difference is you have to see it coming. If you're holding everything that peaked in the bubble, including your house or anything, it's going to go down and it's going to end up being a loss, and it's going to take you forever to recover those losses, okay? If you get out of the way of the bubble in every way possible. And again, I am quickly finishing some improvements to my house to put it on sale, literally like in the next week or two. I wanted to do this earlier, but it's taken longer. I mean, any asset you can cash out of now, certainly, I mean, stocks, you can sell them in a moment, gold, commodities, and will be a bargain. You're going to be able to rebuy stuff and greatly improve your standard of living. It's also true in business. In business, when industries and sectors of the economy go down, and almost all going to go down, some just more than other, what it does, it makes the strong stronger, and it flushes out the weak. So the businesses that also see this coming and stop spending money, sell off assets they don't need, create cash, cut their costs now. They come into it lean and mean, they're only going to gain market share as all their competitors fall. Somebody has to survive. Everybody's not going to go under. So let's say there's 5 major competitors that matter in your sector or whatever business you're in. It's probably going to go down to 2 or 3, and you guys are going to more than double your market share if you hunker down. So the same thing happens. Look at your business. Look at your own house, your own real estate. Look at everything financial in your life. Everything's going to change, and everything's going to be an opportunity for the people who act ahead of the crash, the bubble burst, and then quickly reinvest at bargain rates when it bottoms. And so your business, you could double your market share and double or triple your long-term returns on your business if you just if you can sell your business, that's all. You could cash in now and then reinvest that in your business or another business. But if you just keep your business and hunker down, you're likely to be at least twice as good off in the long term, and maybe 3 times from just doing the right things and being there, because your business is still there, being there to take advantage of everything when it's down, and take all these customers that are lost from the businesses that can no longer service them because they borrowed too much or they built too much plant capacity, got too much fixed cost. So the opportunity's everywhere. Move. I mean, the exurbs are the best place, people in certain high priced areas. Well, either rebuy in your great area, but a lot of these areas may be tainted. Buy in the new exurb. If you sell now and you're more in the suburbs, well, now that you're out and you have time to rebuy, well, you're going to probably do best buying in the exurbs, because exurbs are growing. Even suburbs are kind of planing out. In urban areas, a lot of them are dying. So there's going to be opportunities to buy in new areas. And also, Vacation homes bubble the most and go down the most. So for people who maybe say couldn't have afforded a vacation home before, well, now all of a sudden you may be able to pick up a ski townhouse or a beach house somewhere at a price you can afford in your retirement, and have a second home, or just move to a vacation area instead of staying in the suburbs. So look at your whole life. This is going to change everything in a short period of time.
Yeah, that's very hopeful for folks, especially that's trying to get ahead, and if they are able to manage the risk now, use some real risk management skills, and be prepared to take courage whenever this downturn.
Well, and I'll add another thing: if you have a boss you really hate because he's really not helping anybody and everybody hates him, that boss will go. Okay, in a downturn, a lot of the bad people will go. and make life easier as well. So again, it happens across that's why I say these shakeouts, these detoxes, whatever you want to call them, they're a good thing. Okay. And so you just don't want to lose most of your assets in this transition. That's just protect what you have, and everything will work in your favor.
Mm-hmm. Gotcha. Well, appreciate you for coming on the show, Harry, and giving us that outlook. And I'm definitely going to take some lessons from that. Where can people connect with you, find more about the work you're doing, read your books?
Yeah. I mean, I haven't written a book in a while. My last one was the Great Depression had, on this topic and stuff. But it's the best thing is my newsletter. I have a free newsletter and a paid newsletter. You can get on the free newsletter today. You just go to harrydent.com. That site's just to push this button and get on our free newsletter. And you'll get an article from me every week and a video rant twice a month for as long as you want. And we just hope that a small percent get on our newsletter, and that's why we can afford to give that away for free. So that's something you can do, and it's very easy.
All right, sounds good. Well, you all have the information. Be sure to go check out harrydent.com. Appreciate you, Harry, for coming on the show, and be sure to hit the subscribe button. Love to have your support and everything as we continue to pump out these interviews. All right, talk to you soon, Harry.
Okay, thank you, Darrell.